Welcome back to NoteLab Mode, where we squeeze all the insights out of your research material.
That's right.
And today we're diving deep into Where the Money Is by Adam Cecil.
Fantastic book.
But we're adding a twist this time.
Oh.
We're going to see how his value investing principles can be like supercharged with today's AI.
Interesting.
And before we get started, a huge thanks to our sponsor, cloutfit.ai.
Okay.
That's CLOUTFIT.ai.
All right.
They're using AI to help fashion brands, really boost their revenue.
Yeah.
Just like we're going to try to unlock the potential
I see.
within Cecil's insight with AI.
Yeah, that makes sense.
So imagine this, an AI that could scan all the markets out there and pinpoint the companies that fit Cecil's criteria.
Wow.
It would just hand you a winning investment strategy.
Sounds pretty good.
I know, right?
Yeah.
That's the exciting thing we're going to explore today.
Okay, I'm ready.
Okay, great. Now, to really appreciate Cecil's approach, I think we need to understand how value investing has evolved over time.
Makes sense.
He starts, way back with the OG, Ben Graham.
The father of value investing.
Often called the father of value investing, right?
Yeah.
Cecil calls his strategy Value 1.0.
Okay.
It was all about finding those companies that were trading for less than their net asset value.
So essentially buying $1 for 50 cents.
Yeah, exactly. He even tells this really interesting story about Northern Pipeline. Graham really digs deep into their financials, discovers they're sitting on a huge pile of cash and securities, more than their entire market cap.
Wow.
He basically forces them to distribute that value back to the shareholders. And of course, he makes a very tiny profit in the process.
Makes sense.
What's so striking about Graham's approach, though,
Yeah.
is just how meticulous he was.
Yeah, he really took his time.
He wasn't afraid to get in there.
Really roll up his sleeves.
Roll up his sleeves, comb through all those financial statements.
Exactly.
To find those hidden gems.
Like a detective.
Yeah, totally.
Yeah.
Then, you fast forward a bit.
Okay.
And we get to Warren Buffett.
A student of Graham.
A student of Graham, yeah. Value 2.0.
Okay.
He shifted the focus, though, from tangible assets like Graham was focused on to the actual strength of the business itself.
Interesting.
He wanted to find companies with what you call these strong franchises.
Okay.
Moats.
Moats, that's a good analogy.
Yeah. And brilliant management teams.
Okay.
So he was looking at companies like Geico and Cap Cities, built for long-term dominance, right?
So not about just buying them, breaking them up and selling the pieces.
Exactly.
Right, more long-term.
They weren't built for liquidation.
Yeah.
But then, of course, the digital age comes along, and it really throws a curveball at these traditional value investors. All of a sudden, we have these, like, tech giants, like Amazon, Alphabet.
Oh, yeah.
That just seem so expensive.
Right.
When you look at them through that classic value investing lens, right?
Yeah, those traditional metrics don't really apply anymore.
Yeah. Those price-to-earnings ratios just don't seem to apply anymore.
Really hard to square them.
Yeah. Even really experienced investors. I mean,
I
remember talking to Lou Sanders, and he just kind of threw his hands up and was like, the world has changed.
He just admitted it, huh?
He just admitted it, like straight up.
Yeah. I mean, the rules of the game have changed.
It really has.
Yeah.
It challenged the assumptions of value investing.
Yeah.
These companies weren't about all those physical assets anymore.
Right.
They were about these intangible things.
Right. It was more about intellectual property.
Exactly.
Network effects, the potential for growth.
Yeah.
Huge growth. Right.
Exactly.
Exponential growth.
Exponential growth. So where does that leave us, right?
Yeah, that's a good question.
Like, where do we go from here?
Yeah.
This is where Cecil introduces this idea of Value 3.0.
Value 3.0, right?
He says it's not just about finding these cheap companies anymore.
Yeah.
It's about finding those companies as strong moats and explosive growth potential.
Explosive growth. Interesting.
I think tech companies, but not...
Right. Not just any tech company, though.
Yeah, not just any tech company.
Right.
We're talking about the ones that are building sustainable advantages in the digital age.
Sustainable, that's the key.
Exactly.
Because a lot of them, they come and go, right?
Yeah, totally.
Yeah.
And that's where it gets really interesting.
Okay.
Because you could imagine an AI that's trained on Cecil's principles, right? It's just sifting through all this data.
Mountains of data.
All this news, even like social media chatter.
Yeah.
To try to find those companies with those very elusive qualities.
I mean, that would be incredible.
It would.
Yeah.
It's like having a little sidekick. That can just help you separate.
The signal from the noise.
Exactly. To help us navigate this new landscape.
Yeah.
Cecil gives us what he calls his BMP checklist.
BMP, okay.
Business, management, price.
I got it.
And he argues that
Yeah.
if you can get those three right,
Yeah.
you're on the right track to outsized returns.
Makes sense.
And we can give AI to take that checklist, right?
Yeah. Take it to a whole new level.
To a whole new level.
Absolutely.
Yeah. So let's start with the B,
Yeah.
the business.
The business.
Cecil really emphasizes
Yeah.
durable competitive advantages.
Mm-hmm.
Those moats that protect the profits.
Yeah.
He breaks it down into three key types, right?
Okay.
Being a low-cost producer,
Okay.
having a strong brand,
Mm-hmm.
or benefiting from those network effects.
Okay. I see. Yeah, that makes sense.
Yeah, so let's dig in a little bit.
Okay. Yeah, let's do that.
Cecil highlights this company called Heiko.
Heiko. Okay.
They dominate the generic airplane parts market.
Interesting.
They can undercut all the big brands on price, but they also have a fantastic safety record.
Wow.
So they've built this moat
Yeah.
that's only gotten wider over time.
Yeah.
It's like the perfect example of that low-cost producer
Mm-hmm.
that's built this really strong reputation for quality.
Mm-hmm.
And, imagine this. You could train an AI
Oh, yeah.
on Cecil's criteria
Mhm.
and have it just scan for companies with
Yeah.
similar characteristics
Mm-hmm.
and potentially find the next typo.
Right. Before it blows up.
Exactly.
Yeah.
Before everybody else knows about it.
Yeah. That's the holy grail.
I know, right?
Yeah.
Another type of moat, of
Yeah.
course, is brand loyalty.
Brand loyalty.
Think
Wow.
of, like,
Like Intuit.
Intuit, yeah.
TurboTax.
TurboTax, yeah.
Yeah.
I use that every year.
QuickBooks.
QuickBooks, yeah. Essential for small businesses.
People rely on these year after year.
I know. It's hard to switch once you're used to it.
And that's the thing.
The switching cost, right,
Yeah.
both in terms of time and effort,
Mm-hmm.
creates a huge barrier to entry for competitors.
It really does.
And the thing about Intuit
yeah.
is they haven't just sat back and rested
Yeah.
on their laurels,
They haven't become complacent.
They've been innovating, expanding their
Yeah.
products.
Mm-hmm.
AI could even
Yeah.
go through all the customer reviews, the usage data, even social media conversations.
Yeah, see what people are saying.
To try to find those companies that
Yeah.
are truly building those really strong brands, exceeding expectations.
That's what you want.
Exactly.
Yeah.
And then, of course, you have the power of platforms.
Platforms.
Probably the most potent moat
Right.
in the digital age.
Absolutely.
I mean,
Yeah.
Apple,
Apple, yeah, the App Store, the whole ecosystem.
App Store.
Yeah.
It's the perfect example.
Yeah. It's like a walled garden, almost.
But Cecil also brings up a more unexpected company. Roku.
Roku, interesting.
They started as a hardware company. Right?
Oh, right.
They started as a hardware company. Right?
Oh, right.
They made those little boxes.
Yeah.
But they really cleverly leveraged that
Mhm.
market share
Mhm.
to become a platform.
Oh, I see, yeah.
And now they take a cut
Right.
of all that revenue from those streaming services.
That's smart.
Yeah, Roku's a great example
Yeah.
of a company adapting
Mm-hmm.
to this new digital landscape, right?
Yeah.
Creating a new type of moat. And
Yeah.
again, you can imagine an AI that can kind of analyze how these business models
Yeah.
evolve, right?
Yeah.
Track the adoption rates
Mhm.
and even try to predict
Yeah.
what companies might
Mhm.
become the next giants.
Yeah.
So we've seen how AI can
Yeah.
really supercharge
Yeah.
Cecil's analysis of a company's business.
Absolutely.
But what about the M?
Oh, yes. M.
Management.
Management.
Cecil says that even the best businesses in the world
Yeah.
can be ruined by
Yeah.
bad leadership.
Absolutely.
So he asks two crucial questions.
Okay.
Do those leaders, right,
Yeah.
do they act like owners?
Mm-hmm.
Prioritizing the long-term value
Mm-hmm.
over short-term gains.
Yeah, that's important.
And do they really understand
Yeah.
what drives the value of a business?
Right.
Those key metrics,
Yeah.
like return on capital,
Mm-hmm.
profit margins.
Yeah.
It's about finding those leaders that are
Yeah.
not only passionate,
Yeah.
but also analytical.
Yeah.
right?
Yeah. And I'd have both.
Yeah.
Yeah.
The ones who can translate vision into actual tangible results.
That's it. Yeah.
He shares this great story about Tom Murphy.
Tom Murphy. Okay.
He was the legendary CEO of Cap Cities.
Cap Cities. Okay.
Murphy was known for his, frugal management style,
Mm-hmm.
almost Spartan.
Really?
He refused to spend money
Yeah.
on things like fancy offices,
Mhm.
private jets.
Wow. Okay.
He would even make his executives fly coach.
That's dedication.
I know, right?
Yeah.
But when it came to the core business,
Mm-hmm.
he was incredibly generous.
Oh, interesting. So he knew where to spend the money.
Yeah, he was
Yeah.
totally fine
Ah.
building a top-notch newsroom.
Oh, so investing in the core of the business.
Exactly.
That's smart.
Murphy just understood
Mm-hmm.
that every dollar
Yeah.
should go to maximizing shareholder value.
Mm-hmm.
Imagine if you had an AI, though,
Yeah.
that could go through and analyze
Yeah.
CEO communications,
All right. Yeah.
track the capital allocation decisions,
Mm.
even, assess the management sentiment
Yeah.
from all those earnings calls and news.
Wow.
It could just flag those red flags.
Like,
Excessive compensation.
executive compensation, yeah. Or, just a history of poor decisions. Right, right. Or it could find those hidden gems where the leaders, they're aligned with shareholder interests.
Yeah,
They would,
like a lie detector.
It's like an AI lie detector, yeah.
Yeah.
Yeah, for management, that's a great analogy.
I know, right?
Yeah.
And that brings us to the P.
The P, okay, Bryce, the big one.
This is where Cecil gets a bit paradoxical. He says price is both the least
Yeah.
and the most important part of that BMP checklist.
Least and most, okay.
I know. So how can that be?
Yeah, how can that be?
Well, price is least important
Okay.
in the sense that
Yeah.
it shouldn't be your starting point. Right.
So you're not just chasing cheap stocks.
Exactly.
Right.
You're trying to find those exceptional businesses first,
Okay.
and then the price becomes important
Okay.
once you've identified those potential winners.
Okay, yeah, that makes sense.
You don't want to fall in love with a company just
Yeah.
because it's on sale.
Right, exactly.
But then why is it the most important?
Yeah, that's what I was wondering.
Okay, so this is why.
Okay.
It's the veto vote.
Okay.
Even the best business,
Yeah.
if you overpay,
Yeah.
it's going to be a terrible investment.
Right.
And this is where those traditional valuation metrics
Mm-hmm.
can be a little misleading,
Yeah.
especially when you're looking at
Yeah.
tech companies.
Tech, yeah.
Think about Amazon.
Okay.
They have consistently invested heavily in growth.
pouring money back
They're
in.
pouring billions of dollars into warehouses, new
Yeah.
technologies, expanding all their offerings,
Mhm.
which, if you're looking at the business, that's brilliant.
Yeah, absolutely.
But all those investments, they
Mhm.
push down
Mm-hmm.
their current earnings.
Mm-hmm.
So they look expensive
Right.
based on those
Yeah.
traditional price-to-earnings ratios.
Exactly.
So
Yeah.
this is where Cecil introduces this concept of
Okay.
earnings power.
Earnings power. Okay.
It's about looking beyond
Got
those
it.
current numbers
Mhm.
and estimating what a company could earn
Right.
if they weren't investing so heavily.
Yeah, okay. Yeah.
It's understanding the potential.
Yeah. Not just the present.
Exactly.
Yeah.
And so how could AI help here?
Yeah. Imagine an AI that could take into account all these earnings power adjustments,
Mm-hmm.
skift through the R&D spending, the capital expenditures, all those factors to get a better understanding of a company's true value, even if those traditional metrics
Yeah,
make it look pricey.
exactly.
Yeah.
It could even project, future cash flows
Yeah.
based on all these market trends, right?
Mhm.
Competitive dynamics,
Mhm.
maybe even using things like sentiment analysis
Yeah.
from social media.
Yeah.
It's like having this AI crystal ball.
Crystal ball.
I know, right?
To see into the future.
That could just help us see the future potential
Yeah.
of these companies.
The earnings power, yeah.
Yeah.
That's the key.
And it's really taking that human intuition
Mm-hmm.
about what drives value and
Mhm.
combining it with the power of AI.
Yeah. What's a powerful combination?
But before we get too carried away with tech,
Yeah.
Cecil reminds us that Value 3.0
Yeah.
isn't all about Silicon Valley.
Right.
There are plenty of non-tech companies that are thriving
Mm-hmm.
in this new digital age.
Okay. Interesting.
He highlights companies like Sherwin-Williams,
Sherwin-Williams paint.
Paint, right?
Yeah.
They have this incredibly
Yeah.
efficient retail network.
Mm-hmm.
Then you have Equifax
Equifax.
that's
yeah.
benefiting from all those advancements in
Mhm.
credit scoring technology.
Right. Yeah.
And then even Dollar General,
Okay.
who's serving this market. It's often
Mhm.
overlooked
Yeah.
in all the digital rush.
Yeah.
So these are companies that
Yeah.
may not be on the cutting edge
Yeah.
of all the new technology,
Right.
but they're either using that technology strategically
Mm-hmm.
to enhance what they're already doing
Yeah.
or serving a
Mhm.
niche that's been
Uh-huh.
overlooked.
Yeah.
And this is where AI can come in again
Oh, okay.
because it can look at all these traditional businesses,
Mm-hmm.
see how they're incorporating technology into their operations
Mm-hmm.
or benefiting from these trends.
Yeah.
So even if you're not like a huge
Yeah.
tech enthusiast,
Right.
there are still opportunities to use Cecil's principles
Mhm.
and find those hidden gems with
Mhm.
AI.
It's about being open to the unexpected.
Yes.
Yeah.
And using AI
Yeah.
to help you uncover those.
Absolutely.
So we've covered a lot of ground today.
We have.
The evolution of value investing, challenges of this new digital age,
Mm-hmm.
and Cecil's BMP checklist,
Mm-hmm.
all supercharged
Yeah.
by the potential of AI.
It's exciting stuff.
It really is.
Yeah.
But there's still so much more to explore, right?
Oh, yeah.
So stay tuned.
I'm excited. So let's look at some of Cecil's real-world examples.
Okay.
Starting with Alphabet.
Okay.
A lot of people might think Alphabet's already been analyzed to death, but
Yeah.
Cecil uncovers some really interesting things that might surprise you.
Okay.
He was looking at Alphabet back in 2016,
Okay.
And they already had, this incredible portfolio of businesses,
Right.
not just Google search.
Right.
You also had YouTube,
Yeah.
Android, Gmail.
Right.
He points out that Alphabet had 7 different platforms with over 1 billion users each.
That's
Right?
incredible.
It's amazing. And Cecil recognized the power of those billion-user platforms. Each one was like this giant magnet, right?
Yeah.
Attracting more users, generating tons of data,
Right.
which they could then leverage
Yeah.
for advertising and other revenue streams.
So they clearly had the B, the business.
They had the B.
But what about the M? The management. The management, Cecil, have some reservations about Alphabet's leadership back then.
Larry Page and Sergey Brin, brilliant engineers, no doubt about that, but not necessarily the most financially focused.
Right.
We're more interested in these ambitious long-term projects than maximizing short-term profits.
Those moonshot projects.
Yeah, the moonshots.
You're always talking about.
Exactly. And those moonshots might pay off eventually.
Yeah, right.
They're also, kind of a drain on resources and could distract from the core business.
But then Sundar Pichai took over as CEO.
Right.
How did Cecil view that transition?
He thought it was a pivotal moment.
Okay.
Because Pichai had a really proven track record of both innovation and execution.
Okay.
He understood the technology, but he was also focused on making money.
Right.
Cecil even described him as someone who could use his engineering chops to unlock Alphabet's full earnings potential.
So it sounds like he brought this much-needed balance of brilliance and financial discipline.
Yeah, he was the perfect person for the job at that time.
But what about the P?
Right.
The price, even in 2016, Alphabet was already pretty expensive stock.
It was.
Yeah.
That's where Cecil's earnings power framework comes in. He looked beyond those headline PE ratios and considered their profit margins compared to other tech giants, compared to other tech giants like Facebook, Alibaba. He also factored in those bets, those moonshot projects that were losing money at the time, but had this potential to become huge winners later on.
Okay.
And when he added it all up, he concluded that Alphabet's earning power was significantly higher than what their reported earnings were showing.
So the market was essentially undervaluing Alphabet's future potential.
Exactly. It was a classic value investing opportunity, even though it was hidden by those seemingly high price tags. Now, let's shift gears a little bit.
Okay.
Look at another company. Cecil analyzed Intuit. What's interesting about Intuit is that they dominate these seemingly mundane markets like tax preparation software, small business accounting software. They might not be as flashy as some of these other tech companies, but they solve real problems that people are willing to pay for.
Exactly.
Cecil's really impressed Intuit's management team. He said they were constantly innovating and even disrupting themselves.
Interesting.
Even though there wasn't a crisis forcing them to...
Which is rare. Most companies get complacent once they've had some success.
They just sit back and relax. But Intuit seemed to have this culture of continuous improvement, always looking for ways to make their products better and expand into new markets. Now, when it came to price, Intuit wasn't as optically cheap as Alphabet. But Cecil, once again, used that earnings power framework to make a case for their undervaluation.
So he adjusted for their investments in growth, and he concluded that they were still attractively priced.
He did.
Even though they might not have had that same explosive growth potential as some of those younger tech companies.
Yeah, exactly. He saw their steady, consistent growth as a sign of their strength and durability. And it's worth noting that both Alphabet and Intuit have performed incredibly well since Cecil made those investments, which suggests that his framework, even though it challenges some traditional value investing, dogmas can still identify those companies that are poised to outperform the market.
Yeah, it's really proof that
it is
a deep understanding of the business fundamentals combined with a forward-looking perspective can lead to incredible results.
Absolutely.
Now let's bring AI back into the picture.
Okay.
How could AI have helped Cecil make these investment decisions?
Well, imagine an AI that could analyze huge amounts of text, like news articles, earnings, call transcripts, even social media posts. It could have helped him assess Alphabet's management team even more thoroughly by analyzing interviews articles about Larry Page, Sergey Brin, Sundar Pichai. Looking for clues about their financial acumen, their long-term vision, and how they balanced innovation with profitability.
It could have even dug deeper into its culture of innovation by analyzing employee reviews, news coverage, even the patents they were filing.
Interesting.
Just looking for evidence of that drive to improve and disrupt themselves.
Constantly evolving.
Exactly.
Yeah.
And then when it came to price, AI could have helped him refine his earnings power calculations even further.
Give him more data. More insight.
Analyzing historical data on spending patterns, how those investments translated into future profits, and even looking at macroeconomic trends that might impact their businesses.
It's like having a whole team of analysts working for you. 24/7.
So AI could have been this incredibly powerful tool for Cecil, not by replacing his judgment, but by augmenting it.
Exactly.
Giving him more data points.
More information.
Helping him see the bigger picture.
The big picture.
Even more clearly.
Exactly.
Yeah, it's a powerful combination. Powerful combination.
Yeah.
Now let's move beyond those tech giants and see how Cecil framework combined with AI can help us identify those less obvious winners, the companies that might not be on everyone's radar, but are quietly building those sustainable advantages in the digital age.
That's what we'll explore in the final part of our deep dive.
So we've seen how Cecil uses his BMP framework to find those winning investments in both tech and non-tech companies. But now let's try to take it a step further and explore how AI could really transform the way we apply those principles in our own search for those, market-beating returns.
It's about taking those core concepts, durable competitive advantages, focus on earnings power, and then amplifying them with the power of AI.
So instead of just looking at, individual companies, we could use AI to scan the entire market.
The whole market, Imagine an AI that can identify emerging trends, shifts in consumer behavior, those subtle signals that tell us about major disruptions.
Like an AI that can read the tea leaves.
They read the tea leaves.
Read the market, and tell you which industries are ready for that innovation and which ones are about to be disrupted.
Turned upside down. That's a powerful concept.
It is a powerful concept.
So once we've identified those promising industries, how do we actually pinpoint the companies?
How could AI help us do that?
Well, AI could analyze a company's patent portfolio, for example. Look for those that are developing those cutting-edge technologies or tackling those problems that are about to become major pain points for consumers and businesses.
So we're not just looking for companies that are riding the wave. We're looking for the companies that are creating the wave.
Creating the wave, exactly. And AI could even analyze the backgrounds of the management team, look for those with experience in disruptive industries or a track record of leading companies through periods of rapid growth.
It's like assembling the perfect team for a high-stakes mission.
But instead of,
pulling off a heist, we're trying to uncover future market leaders.
Exactly. Now, when it comes to non-tech companies, AI could be especially useful in identifying those that are strategically leveraging technology to make their existing businesses better.
Like Sherwin-Williams.
Sherwin-Williams,
They built this incredibly efficient supply chain and distribution network, all powered by data
and algorithms, even though they're not a tech company. At their core, At their core. AI could analyze data from their stores, their suppliers, their competitors, and figure out where they're doing well and where they could improve.
It could even suggest new ways to use technology, like using AI robots in their factories, or developing new kinds of paint that are more durable or environmentally friendly. So AI could help those traditional companies become more competitive.
More competitive,
in the digital age.
Absolutely.
And AI could also help us find those seemingly boring companies like Equifax.
Equifax,
that are quietly benefiting from advancements in technology. AI could analyze all that data on consumer credit and look for new opportunities for Equifax to expand their offerings or make their risk models better.
It could even help them develop new ways to assess creditworthiness, maybe, by looking at alternative data sources like social media or online transactions.
And then you have those companies like Dollar General.
Dollar General,
that are serving those markets that have been overlooked by the digital revolution.
AI could help them identify the communities that really need the
Right.
products and services.
It could even help them optimize, their store locations, their product selection, even their pricing
Their pricing, yeah.
to serve those customers better.
AI can really help us see the potential in companies that others might just dismiss.
Right.
But here's
Yeah.
the really exciting part. AI could even help us go beyond Cecil's framework
Okay.
and identify factors that he might not have even considered.
Like
Sustainability?
Sustainability, right?
Yeah.
That's becoming more and more important.
Yes,
Consumers are demanding
absolutely.
that companies act in a
Yeah.
more responsible way.
Environmentally
And socially, so AI could help us figure out which companies are really committed to sustainability.
And not just greenwashing.
Greenwashing,
Right.
yeah.
It can analyze data on their carbon emissions,
Right.
their supply chains, their labor practices, even their political contributions.
It could even analyze news coverage and social media sentiment to really gauge how the public sees their sustainability efforts.
And that could help us identify those companies that are not only good investments, but also good corporate citizens.
So it's about more than just financial returns.
It's about
investing in companies that are making a positive impact.
making a difference.
Making a difference.
And that's where AI could really revolutionize value investing.
It's not about replacing our judgment or
Right.
blindly following algorithms.
It's about using AI to make us smarter,
Yeah.
to help us see those patterns that we
Right.
might miss.
And to make those tough decisions with more confidence.
More confidence and conviction.
It's a really powerful combination
It is.
of human insight
Human
and artificial intelligence.
Sarsation intelligence.
So that's the challenge
Yeah.
we'll leave you with today.
As you're exploring your own investing ideas,
Yeah.
think about how you can use AI.
What questions could you ask?
What data could you analyze?
What insights could you uncover?
Yeah.
The future of value investing.
It's here.
And it's powered by
That is
that.
powered by AI.
Thanks for joining us. Thanks for joining us
On this deep dive.
on this deep dive into where the money is.
Where the money is.
Supercharged by AI.
Until next time.
Until next time.
Keep learning. Keep exploring.
Keep exploring. Keep an eye
Keep an eye out
for those hidden gems.
for those hidden gems.
Instead